Congressional Testimony, Reexamining the Economic Costs of Debt by L. Randall Wray. Section 9. Foreign Holdings of U.S. Treasury Debt. Some claim that excessive U.S. federal indebtedness forces the Treasury to borrow from abroad and that at some point foreigners might refuse to lend more dollars. In recent years, foreigners hold nearly half the Treasury bonds held by the public. Foreign official holdings in foreign central banks and treasuries account for nearly two-thirds of the total held abroad. Most of the foreign holdings are in countries that are net exporters, and almost all the rest is held in offshore banking centers. Foreign individuals account for just 10% of foreign holdings. Ray, 2019a. The following graph shows the total federal government debt held by the public as well as the portion of that debt held by foreigners, both as a percent of global GDP. As a percent of global GDP, the debt ratio has gradually climbed back to where it was in 1960. In 1960, however, the world was on the Bretton Woods system, in which the U.S. dollar was pegged to and competed with gold as the international reserve. Today, the dollar is the primary international reserve currency. As of 2016, the ratio of federal debt to global GDP was about 18%, and the portion held abroad was less than 8% of global GDP. This could be the more relevant yardstick for measuring the debt ratio for the international reserve currency. This could be the more relevant yardstick for measuring the debt ratio for the international currency reserve. Other than the offshore banks, U.S. Treasury holdings are mostly accumulated by countries running bilateral current account surpluses against the U.S. Footnote 11. When private exporters sell to Americans, they convert their dollar earnings to domestic currency deposits. Their domestic banks then convert dollars to domestic currency reserves held at their central banks. These foreign central banks hold dollar reserves at the Fed, which are converted to U.S. Treasury bonds to earn interest. End footnote. It is highly unlikely that the demand for U.S. dollars is even close to satiation. International exporters trade with the U.S. because they want U.S. dollars, mostly because they need them for imports or to manage their exchange rates. Further, during the last global financial crisis, there was an immediate run to dollars, only relieved by massive intervention of the Federal Reserve, which originated over $29 trillion in loans, of which approximately 40% went to foreign central banks and much of the rest went to private global banks. U.S. Treasuries are held as the safest financial assets in the world. When the rest of the world finally gets all the treasuries they want, they'll stop targeting the U.S. with their exports. That will allow our current account deficit to shrink, which will allow the budget deficit to fall for any level of the domestic private sector surplus. If the current account deficit were to fall to zero, the budget deficit would fall to equality with the private sector surplus. All else equal, this would lower the path of the growth of the debt to GDP ratio.